In this video we are going to talk about how to trade stocks like a pro. So before starting this video, please like this video and subscribe to our channel for future updates. When you think of a trader, you might picture someone who buys and sells stocks on a daily basis. These are those who are well versed in the stock market and wish to profit from daily price swings on Wall Street. These are hourly traders that are looking to earn a quick cash. They rarely sit on a stock for more than a day, and when they do, it's for a short period of time. You are an investor similar to Warren Buffett if you wish to save money for retirement or invest in a firm that you believe will return a large profit in the future. The stock market guru is a long-term investor who has amassed a sizable fortune through his astute trading abilities. There are several forms of trading based on frequency, trends, purchase and sell activity, and what you choose to deal in. Establish your objectives. Investors who want to trade the stock market should first figure out what they want to get out of it. To devise your strategy, you must first decide where you want to go. Do you want to put aside enough money for retirement? Do you wish to accumulate enough wealth to cover your children's college expenses? You could also be putting money aside for a different objective, such as beginning your own business. You might be thinking of doing some day trading with your available funds, or you might be thinking of something a little more lighthearted. Whatever scenario best describes your situation, the most important thing is to determine your financial goal. Have the right attitude. Once you've decided on your objectives, having the correct mindset can help you achieve them. If you want to make money trading stocks, you should approach it as a profession rather than a pastime. If you don't take stock trading seriously enough, you may find yourself with a lower likelihood of success and lower returns. It can take a long time to find the appropriate stocks or leverage tactics that are lucrative. Determine how much risk you're willing to take. Determining your risk tolerance, or the amount of volatility you are ready to endure, is another important aspect of stock trading. One way for an investor to determine this is to consider how you might react to certain market conditions, such as a rapid drop in stock prices. It's vital to distinguish risk tolerance from risk capacity, which refers to how much risk an individual investor can handle. To put it another way, risk capacity is the amount of risk you can handle without jeopardizing your ability to meet your financial objectives. Some traders may benefit from seeing a financial advisor to better understand these issues. A financial planner can help you assess your risk tolerance. You may tell whether you are aggressive, moderate, or conservative by looking into this. You can employ a plan that represents your ability to stomach risk once you've identified your risk tolerance. To effectively control risk, you can build a diversified portfolio that includes a variety of equities. This could contain equities from a variety of companies of various sizes, as well as stocks from companies all around the world. Here are ways how to trade like a pro. Understand the terms used in the industry. Another critical step for traders to do is to familiarize themselves with vital industry lingo. There are numerous guides available on the internet that people can utilize to get up to speed on this material. Market capitalization and liquidity are two terms that can be incredibly beneficial to an investor wanting to trade stocks successfully. Investors can benefit from looking at several variables such as the price-earnings ratio and return on equity when examining specific stocks, ROE. An investor can get a better understanding of whether a stock is undervalued or overvalued by looking at these indicators. Establish a savings account. An investor must first open an investment account in order to trade stocks. A bargain broker may be a good choice for someone who has progressed past the novice stage. These are usually less priced than full-service alternatives, which makes them more tempting. While discount brokers may appear to be a good way to save money, traders who are considering utilizing them should do their homework first. For example, you should look at the fee schedule of the bargain broker to see what the major charges will be. You should also ensure that the cheap broker you choose allows you to trade the securities you desire. Furthermore, ensure that the broker provides the services you require, such as research on various assets or the capacity to execute trades over the phone. If you do decide to go with a cheap broker, make sure you understand the minimum deposit required to open each type of account. A seasoned investor may prefer a full-service broker over a discount broker since full-service brokers offer more possibilities. A full-service broker, for example, might allow interested traders to participate in initial public offerings, IPOs, or gain access to proprietary research. A full-service broker can also assist with potentially risky situations like as retirement planning. Make use of a demo account. Setting up a practice account and trading stocks with it before getting involved and risking real money is one strategy that can be highly beneficial. Many new investors lose money, so working with a practice account allows you to learn how to make transactions that might otherwise be unprofitable without losing any of your own money. Many brokers provide paper trading accounts, which allow investors to practice trading. Understand the different order types. It's crucial to understand the difference between a market order, which requests that an asset be purchased at market price, and a limit order, which is activated when an asset hits a specific price. For example, if you wanted to buy Apple Inc. AAPL stock but thought it was overvalued, you might place a buy limit order that would allow you to buy whenever the stock fell to a certain level. Invest in companies rather than stocks. Investors may become overwhelmed by information at times. Remember that each share symbolizes ownership in a company when narrowing down a list of stocks to trade. You can then determine which companies you want to invest in based on this information. Those considering stock trading should consider whether the companies have a solid competitive edge and enticing long-term potential. Make a strategy and stick to it. Once you've devised an investment strategy, you should stick to it. Volatility is a normal part of the stock market, so if you buy stocks, you should expect them to go up and down in value. Staying disciplined after formulating a plan can be extremely beneficial to investors. To put it another way, it can assist people avoid being sidetracked by news headlines or analyst predictions about which stocks will create high returns. Be realistic about profits. To be profitable, a strategy does not have to win all of the time. Many traders only win about half of their transactions, 50 to 60%. They make more money on their victories than they do on their failures though. Make sure that each trade's risk is limited to a certain proportion of the account's value, and that entry and exit procedures are properly stated and documented. Stay cool. The stock market may be a nerve-wracking experience at times. As a day trader, you must learn to control your emotions such as greed, hope, and fear. Decisions should be based on reasoning rather than emotion. Make use of your gut feelings. Trading necessitates the development of both the mathematical and aesthetic aspects of your brain, so you must cultivate both to be successful in the long run. Once you've mastered math, try meditating, doing a few yoga poses, or taking a peaceful walk in the park to improve your performance. Reinforcement should be avoided at all costs. Adrenaline and endorphins are released while you trade actively. Even when you're losing money, these hormones might make you feel happy. As a result, addictive personalities are enticed to take up dangerous jobs only to get a buzz. You're probably trading for the wrong reasons if you're looking for a rush and excitement. You shouldn't count your chickens. It's fine to be ecstatic about a winning trade, but the money won't be yours until you close out or cover the position. Use trailing stops or partial profits to lock in what you can as early as possible, so the market's hidden hands don't pilfer your earnings at the last minute. Simplicity is a virtue to be embraced. Concentrate on the price action and accept that everything else is secondary. Build sophisticated technical indicators if you like, but remember that their main purpose is to corroborate or dispute what your eyes already see. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.